What if nearly half of all retirees watched a promised check of $2,000 vanish before their eyes? A widespread belief is forming right now. Many seniors think that if another stimulus payment is approved, they'll naturally be on the list to receive it. But the regulations currently under consideration could turn that belief into a very expensive error. Recent projections indicate close to 42% of retired individuals could end up with nothing. This isn't about funds being depleted or personal failure. It's about a fundamental gap between perception and the actual eligibility criteria. This isn't a media story. It's a rulebook issue. These payments aren't determined by your age, your monthly bills, or your perceived need. They are calculated from tax documents, your filing category, and how your earnings appear within the IRS framework. And this is precisely where countless seniors unintentionally disqualify themselves. Some think Social Security guarantees inclusion. Others believe total household cash flow is what the government reviews. Plenty assume staying below a published income figure ensures a deposit. In reality, none of these assumptions are consistently accurate. For someone on a fixed income, $2,000 isn't bonus cash. It's the electric bill. It's crucial medication. It's the grocery run for the month. Losing it due to a correctable oversight, rather than true ineligibility, is perhaps the most avoidable and frustrating result possible. Today we'll detail why such a large portion of retirees are in danger of receiving zero, which regulations truly govern this process, and how you can determine your standing before jumping to conclusions. Because when it comes to government payments, the line between getting funds and getting nothing is usually defined by one action: learning the regulations instead of estimating them, the most significant error retirees commit regarding earnings. A primary explanation for why so many end up in the $0 category stems from one flawed concept. They assess their financial intake incorrectly. Most people in retirement view income as a household would. It's all cash entering the home from every person and every source combined. That seems sensible. But stimulus qualification doesn't operate on that principle. The IRS doesn't examine household cash flow. It examines taxable income from your return. That distinction is more critical than almost any other factor. Eligibility hinges on your tax filing category: single, married filing together, head of household, and the adjusted gross income connected to that specific document, not who resides with you, not how many adults help with expenses, and not how bills are split. In homes with multiple generations, this error is incredibly frequent. Parents presume an adult child's salary rules them out. Grandparents think sharing a home with family instantly raises their income above the cap. In truth, one individual's earnings do not erase another person's qualification unless that person is listed as a dependent on the same tax form. This single misunderstanding leads thousands of retirees to conclude they aren't eligible and to never investigate properly. And once that conclusion is reached, money that was potentially available is just left behind. Comprehending the IRS's official definition of income is the initial move in figuring out if you are legitimately qualified or if you are inadvertently ruling yourself out. The actual income ceilings and why news reports mislead. One of the most deceptive aspects of stimulus reporting is the solitary income figure everyone recalls. You've likely seen reports stating payments go to individuals making under, say, $100,000. That seems straightforward and comforting, yet it's also insufficient. Stimulus qualification isn't governed by one universal earnings cap. It varies by your filing status. Looking at previous payment structures, the full amount usually went to single filers with earnings up to $75,000. Couples filing together, up to $150,000. Heads of household, up to $112,500. Exceeding these benchmarks doesn't make the payment vanish immediately. It reduces slowly. This is where numerous retirees sacrifice money without knowing it. People hear one number, decide they're above it, and cease investigating. But being a little over the line frequently means you still qualify for a reduced amount, often a substantial part of it. A retiree with income just past the threshold might still get $1,500 or more, yet if they think I earn too much, those funds are never requested. Another crucial piece is what income is actually counted. The IRS uses adjusted gross income, not your monthly cash deposits or pre-tax totals. Social Security is included only if a portion is taxable, which depends on individual circumstances. Headlines make it simple. The rules do not. Knowing the real thresholds and how reductions work can separate receiving a portion from receiving a void. So what actually determines if you qualify? At this point, a vital reality must be understood. Stimulus eligibility isn't decided by a single digit. It's determined by a mix of conditions, and overlooking just one can mean the difference between funds and a zero balance. Based on earlier payment rules, 7 key elements carry the most weight. First is adjusted gross income, or AGI. This is the figure the IRS genuinely uses, not your monthly bank deposits or total home cash flow. Second is your filing status. Single, married filing jointly, or head of household. Each has unique thresholds and guidelines. Third is whether another taxpayer claims you as a dependent. If you are claimed, you could be excluded even with low personal income. Fourth is whether you claim dependents. This can influence your total possible payment. Fifth is whether the IRS has a recent tax return from you. No current record often leads to holdups or missed payments completely. Sixth is whether you get Social Security, SSDI, SSI, or VA benefits. These programs interface with payment distribution systems in different ways. And seventh is whether the money is sent as an advance or a refundable credit on your taxes, a nuance affecting when and how you get it. None of these elements operate alone. The system evaluates them in combination. That's why guessing your status based solely on an income figure leaves so many retirees watching from the sidelines. Why individuals who don't file taxes and Social Security recipients often wait longer. A deeply confused aspect of stimulus payments involves people not required to file annual returns. Many seniors assume that because they receive Social Security, SSDI, or SSI, and aren't obliged to file, the IRS automatically possesses all necessary data. That belief is frequently incorrect. Stimulus funds are distributed via the IRS infrastructure, not directly through Social Security. And the IRS depends heavily on recent tax records to decide eligibility, amount, and delivery details. If no recent return exists, the system has holes. In past payment cycles, millions of older Americans faced delays, not because they were unqualified, but because the IRS lacked updated data, addresses were old, bank info was absent, or income details were too outdated to confirm automatically. Some retirees ultimately got payments months later. Others had to wait until the money was reissued as a refundable tax credit, meaning filing a return they never planned to file. This is particularly aggravating for people who followed all rules. Not filing is perfectly legal for many seniors, but not being clearly visible in the IRS system can quietly slow every step. That's why non-filers and Social Security recipients are often last in line, even when fully eligible. Grasping this timing problem doesn't solve the delay, but it clarifies why being qualified doesn't always mean being quick. The 6 distinct groups of retirees and why a single rule fails. A key reason stimulus rules generate such confusion is the assumption everyone is judged identically. They are not. In practice, retirees fit into 6 separate eligibility categories, and each category engages with the rules differently. Group 1 is single filers with work income. Eligibility depends on individual AGI and filing status, not age. Group 2 is married couples filing a joint return. Here, combined AGI is key, but the phase-out range is broader, meaning many couples still get partial sums. Group 3 is households with dependents. Claiming dependents can raise payment totals, but also adds complication if dependents are adults or split between homes. Group 4 is retirees over 65 receiving only Social Security. Many qualify, but delays are typical without a recent tax return on record. Group 5 includes people on SSDI or SSI. Historically, SSI recipients almost always qualify, but payment timing hinges on data sharing with the IRS. Group 6 is multi-generational households. Here, confusion reaches its peak. Living together does not merge eligibility. Each filer is assessed separately unless listed as a dependent. These groups can overlap, but they don't follow identical protocols. That's why applying someone else's situation to your own rarely works. Eligibility is individual, not collective. Believing my case is like theirs is among the quickest ways retirees miss money they had a right to receive. 3 specific reasons qualified retirees still see $0. This is where immense frustration builds. Individuals meet the income caps. They belong to an eligible category. And still, the payment doesn't arrive. Usually this occurs for 3 precise causes. The first cause is being listed as a dependent. Even with low personal income, even in retirement, if another taxpayer legally claims you as a dependent, your own stimulus eligibility can fall to nothing. This shocks many seniors residing with family. The second cause involves federal intercepts. If you owe specific federal debts, like past due child support, certain tax liabilities, or government-related obligations, stimulus payments can be seized before they ever reach you. Eligibility exists on paper, but the money is rerouted. The third cause is missing or invalid identification in the IRS system. People without a valid Social Security number for employment, or those using only an ITIN, are often excluded under stimulus regulations, even if they've paid taxes for decades. None of these causes relate to need, and none are apparent when people skim headlines. That's why so many retirees state, "I was qualified, but I got $0." Understanding these exclusion filters matters because they explain why eligibility by itself isn't sufficient. The system applies screens, and if you trigger one, the payment halts. Phase-outs. Why exceeding the limit doesn't mean total loss. One of the costliest miscalculations retirees make is believing this. If I'm over the income limit, I receive nothing. That belief is incorrect, and it has caused many who were eligible to forego money they had a right to claim. Under stimulus guidelines, income limits are not hard barriers. They are gradual reduction zones. This means payments shrink slowly as income climbs. They don't disappear all at once. For instance, an individual earning just a bit above the full payment threshold might still qualify for a significant partial amount. In prior programs, retirees who assumed they earned too much often left several hundred or even over $1,000 unclaimed simply because they never ran the actual numbers. Phase-outs are computed using adjusted gross income, not monthly spending or cash available. The decrease happens incrementally, not as a cliff. This is particularly important for retirees with mixed income, Social Security plus a small pension, part-time work, or withdrawals from retirement accounts. A one-time income increase can shift you into the reduction zone without erasing eligibility entirely. But here's the issue. Once someone assumes disqualification, they stop paying attention. They don't verify. They don't claim. And partial payments that could have assisted with real costs are never obtained. The takeaway is clear. Being over the limit does not automatically equal $0. Assuming it does is how funds remain untouched. Scams, false information, and what retirees must deliberately avoid. Whenever stimulus payments are in the news, something else emerges almost instantly: misinformation and fraud. For retirees, this is among the most hazardous parts of the process, because uncertainty creates openings for criminals. Here is the paramount rule to remember. The IRS will not call you about stimulus payments. They will not text you. They will not email you asking for private data, fees, or confirmation to release your money. Any communication generating urgency, act now, verify immediately, payment on hold, is not legitimate. Another issue originates from misleading online material. Videos, posts, and advertisements often oversimplify eligibility. They declare things like, "everyone qualifies," or "money is guaranteed." Those claims are false, and trusting them leads retirees to stop checking authentic rules. Scams don't always steal money directly. Sometimes they steal trust. They persuade people to stop paying attention, stop verifying, or rely on the wrong source. The safest information always comes from official IRS portals and direct government letters, not forwarded messages, not social media, and not individuals offering paid assistance to accelerate the process. In times like these, inaction is often safer than incorrect action. Ignoring noise, hype, and pressure shields retirees far better than reacting to a fake urgency. What retirees should do instead of estimating eligibility. Right now, many are doing the identical thing. They're guessing. They catch a headline. They recall a number. They compare themselves to a friend or relative. And then they silently decide, I probably qualify. Or, I probably don't. That method is fraught with risk. Stimulus eligibility isn't intuitive, and it isn't designed to be guessed accurately. It's based on particular IRS data points, not feelings or comparisons. Instead of guessing, retirees should concentrate on 3 concrete actions. First, know your filing status and your most recent adjusted gross income. These 2 facts alone resolve most uncertainty. They are the bedrock of eligibility. Second, confirm whether the IRS has a recent tax return from you. Even a basic or zero income return can differentiate between an automatic payment and a lengthy delay. Third, understand if you are claimed as a dependent or if you claim another person. This single element has excluded more retirees than nearly any other regulation. None of this demands advanced tax expertise. It demands clarity, not haste. The worst result isn't being ineligible. The worst result is presuming you're ineligible when you're not, and never investigating further. Swapping guesswork for verification doesn't guarantee a payment, but it ensures that if you do qualify, you don't lose money simply because you didn't look thoroughly enough. Why reviewing eligibility doesn't mean filing taxes instantly. A major reason retirees shy away from checking eligibility is apprehension. Fear that looking too closely will compel them to file a return. Fear it will spawn new responsibilities. Fear that once they start, they can't stop. That fear is understandable, yet it's also misguided. Reviewing eligibility does not automatically obligate you to file a tax return. It does not prompt audits, and it does not create fresh legal duties by itself. An eligibility review is about gathering information, not taking action. You can confirm your filing status. You can examine your latest adjusted gross income. You can check if the IRS has a return for you. None of those steps commit you to filing anything immediately. In fact, many retirees who ultimately do need to file, such as non-filers qualifying for a refundable credit, benefit from knowing that before deadlines pass, not after money is missed. Avoiding eligibility checks doesn't protect you. It only raises the odds of an unwelcome surprise later. Another key point, filing a simple or zero income return isn't a penalty. For many retirees, it's a procedural step, not a financial strain, and it's frequently the sole method to claim money you already qualify for. Knowing your position provides options. Not knowing eliminates them. Checking eligibility is about clarity, not commitment. The final error that makes retirees miss the $2,000. After income rules, filing status, phase-outs, and delays, one last mistake quietly causes retirees to miss stimulus money. They do nothing and presume the system will correct it later. This mistake often sounds logical. If I qualify, the money will come. If there's an issue, the IRS will contact me. If I miss it now, I can always get it later. Regrettably, that's not how these programs operate. In past stimulus rounds, unclaimed payments didn't wait indefinitely. Deadlines lapsed, filing periods closed, and individuals who never verified eligibility or never filed when required lost the funds permanently. The system doesn't pursue individuals. It processes records. If the IRS lacks the correct information at the right moment, payments proceed without pause. This is especially perilous for retirees who assume Social Security alone ensures payment, for those who believe partial payments aren't worth the hassle, or for those who think missing one round is inconsequential. It isn't. Once a stimulus opportunity expires, there is no appeal based on need, age, or hardship. The rules are mechanical, not compassionate. The ultimate mistake isn't misunderstanding the rules. It's assuming time is unlimited when it is not. How retirees should view this potential $2,000 without anxiety. Now, the most critical issue is no longer the regulations themselves. It's perspective. For many, the idea of a $2,000 stimulus rapidly becomes emotional. It feels personal. It feels essential. And gradually, it can quietly transform into something people rely on before it's confirmed. That's where stress originates. A healthier approach is straightforward. Treat it as a possibility, not a promise. If the payment materializes and you qualify, it can aid with real necessities: groceries, utilities, medical expenses. But your financial security should never hinge on a payment still bound to rules, deadlines, and IRS documentation. This mindset guards against two extremes. The first is false hope, constructing expectations around money that may never come. The second is constant dread, fearing loss before anything has been decided. Neither is helpful. Retirees who navigate this most effectively focus on what they can control: their records, their awareness of eligibility, and their response timing. They don't panic. They don't assume. They don't ignore deadlines. Instead, they stay informed, prepared, and adaptable. Thinking clearly about this potential money doesn't diminish its importance. It safeguards your peace of mind while waiting. And in retirement, calm decision-making is just as valuable as any single payment. The final lesson: how not to forfeit $2,000 simply by assuming. As we conclude, one message must be heard by every retiree. Most people who miss out on stimulus funds don't lose them because they were ineligible. They lose them because they presumed they were. They presumed their income was excessive. They presumed Social Security handled it all. They presumed living with family disqualified them. They presumed being over a limit meant zero. They presumed another opportunity would always exist. Those presumptions, not the rules themselves, are what costs individuals real money. Stimulus programs don't reward need. They don't reward effort. And they don't correct misunderstandings. They reward precise records, proper timing, and people who verify instead of guess. For retirees, the safest stance isn't optimism or pessimism. It's informed realism. Know your filing status. Know your AGI. Know if the IRS has current data for you. And know that partial eligibility is still eligibility. If you qualify, move within the allotted window. If you don't, you sacrifice nothing by knowing the truth. But assuming without checking is how $2,000 silently evaporates. In retirement, financial security rarely comes from grand gestures. It comes from small, consistent habits: checking instead of guessing, understanding instead of assuming, and acting before deadlines shut. If this breakdown helped bring clarity, would you do me a favor? Hit the like button to support my channel. It truly helps us continue creating content that cuts through the confusion. Thanks for watching.